Perfect. Hello, everyone. Thanks for jumping into our webinar today. We're really excited to present. We'll just give it a few minutes. I can see you all jumping in now. So I'll just give it a minute or so, and then we will get started. So welcome everybody. I'm not sure if you can see that, but Haley has just posted a message in our chat bar function as well. So Haley is part of our customer support team here at Superhero. So she will just be in the chat in the background, answering any sort of operational questions you might have during the proceedings. Obviously, feel free to jump in there, say hello, let us know where you're tuning in from on this rainy Tuesday. If you're in Sydney, hopefully you're somewhere a little bit brighter, and we might get started. So my name is Jack. I'm head of content here at Superhero. Today we're obviously looking at crypto, and we're very grateful to be joined by ETF Securities. And from ETF Securities, we have Kanish, who's going to be presenting this webinar. Thanks for coming along.
No, Jack, thank you for having me.
Perfect. Well, I'll just quickly run through a few formalities. So as I say, Haley's in the background. If you do have any questions about crypto, I just ask that you drop them in the Q&A function, and we'll get to them at the end. We should have probably about 15 minutes to answer any questions that we don't kind of address through the presentation. So as a bit of a formality, this webinar is sponsored and presented by ETF Securities. Superhero does not provide financial advice that considers your personal objectives, financial situation, or particular needs. With that being said, I'm going to throw over to you, Kanish, to get us started.
Thanks, Jack. And as you and I discussed, happy to, if there are questions or if there's things that you would like me to try and explain a bit more as we go through the presentation, just feel free to jump in. And likewise from everyone else, make sure you do send some questions through. Hopefully, I'll be able to answer all of them, or if not, maybe come back to everyone, post the webinar with any information that I can't provide. But also from the ETF security standpoint, just would like to show our disclaimer here as well. And the information that's provided in today's presentation, it's in general in nature. It does not take into account anyone's personal objectives. And we would like to make sure that everyone speaks to an investment professional, financial advisor, reads through the PDF, so the product disclosure statements, and also the TMDs of any product that they're looking to invest in. And all of these are available for our product on our website, etfsecurities.com.au. So the presentation today, it's really around cryptocurrency and cryptocurrency ETFs. It was a really big project from an ETF security standpoint to be the first ETF provider in Australia. And actually, when I was looking at it across the Asia Pacific region, to launch spot cryptocurrency ETFs. So we'll talk a little bit around what that all means, and we'll also talk in terms of the history around cryptocurrencies. We'll try to give everyone a bit of an outlook on, obviously, the volatility. You can't shy away from that at the moment. We'll also talk a bit around, investing directly into crypto versus investing into crypto ETFs. And then I'll discuss briefly also the two funds that we launched as well. And they are the Bitcoin ETF. So that's the ETFs 21 shares Bitcoin ETF, and the ticker for that is EBTC. And the other fund that we launched is the Ethereum exposure, and that's the ETFs 21 shares Ethereum ETF, and the code for that is EETH. Now, these products also we've launched in partnership with 21 shares. And for those that aren't aware who 21 shares are, well, and it may not be surprising, or a lot of you may not be aware of it, but 21 shares are actually one of the largest crypto fund managers in the world. They manage over about $2.5 billion across all crypto currency exposures, and that's their speciality. So ETF Securities, for those that aren't aware, we're an Australian ETF provider. We have, as of today, we actually launched 2 fixed income ETFs, so we're not going to talk about those. We launched 2 US fixed income ETFs today, But as of today, we have 23 products that we offer across many different asset classes: crypto, commodities, equities, international and domestic, and obviously now fixed income. We manage close to about 5 billion Australian dollars across those 23 exposures. So we are essentially ETF experts. We are very much in tune with how to launch ETF products. But when it came to cryptocurrency, this is a new asset class, and we wanted to partner with a global powerhouse in 21Shares to help us launch these funds, and that's how we've done that with that partnership there.
And I should probably jump in there and highlight the significance of that launch earlier this year, because obviously cryptocurrencies have been around for quite a long time, more than 10 years. But to actually have ETFs operating on the Australian share market and sort of giving investors direct access to that through an ETF structure is very, very new. ETF Securities obviously launched that this year. So congratulations on that, obviously.
Yeah, it is funny. It was from when we launched the first prospectus, or the product disclosure statement, which is essentially the first sort of regulatory filing for these products. It was 5 years. So wow. It was a very long time from that point to obviously launching the funds. And I think it was for us, we were asked, how do we feel about that? The fact that it took so long. I think one thing to note is it's a new asset class. So service providers, regulators, there's a lot of different stakeholders in launching an ETF, and people need to get comfort around what is a new asset class. And so it did take time. Whilst we may have been comfortable with the structure, or we may have been comfortable to have launched that fund and operationally been able to operate it, there's still a lot of work and a lot of different service providers, external regulators, the exchanges, et cetera, that needs to go down that path. And so that's why essentially it took as long as it did. And the fact that we're still the first in Asia Pacific shows that we're actually leading the way in this region as well, in this asset class, which is good to see.
Absolutely. And I think as we sort of go through the history of these assets and the nature of them, I guess we'll see sort of how far we've come over the last sort of 10, 15 years.
Which is a really good segue, Jack, so thank you for that, because when we talk about history, what I'm looking at here and what I've shown you up on the slide here is essentially some of the key milestones. And to that point, the history is actually really short. From the very first white paper that was issued by Satoshi Nakamoto. Now, whether he is an individual, whether it's a group, I don't know, but, and there's a lot of conspiracy theories out there, but essentially from that first white paper in 2008, the cryptocurrency asset class has definitely come a long way. You talk about in 2010 that, that pizza day. So that pizza day essentially is a day in May. I think it's the 22nd of May from memory, but there's a particular date in May in which 2 large pizzas were bought for 10,000 Bitcoins. And if you converted that into today's price, it could be anywhere between around that 200 million US mark for those 2 large pizzas. So definitely a long way that Bitcoin has come, and there's still a lot of skeptics out there around cryptocurrencies, and that's fair enough from that side. But in the launch of Ethereum, in terms of a alternative infrastructure from a blockchain technology perspective, and the necessity around that is there. And then in terms of the Bitcoin idea, it actually came when you think about the fact that it was launched in 2008. What happened in 2008? It was a GFC. People were looking for alternatives away from sort of centralized currencies, investments. You had that idea of the blockchain technology provided a really decentralized solution. So I guess what we're trying to show here is it's very early in evolution in terms of the cryptocurrency asset class. You look at equities, other asset classes, whether it's commodities, all these different types of asset classes, property even, they've got a long history. They've evolved over time from when they were first sort of deemed as being an investment solution. And cryptocurrency has a long way to go, and it has a long way to evolve as well. So just something to keep in mind.
Yeah, and I think for me, the most interesting part of that chart is when we get down to 2021, and you can kind of start to see that kind of mainstream adoption. You've got sort of companies, listed companies like Tesla, finance platforms like PayPal and Visa adopting it and kind of accepting it as a means of payment. And
when we move forward is some key terms in terms of what we're looking at. Whether it's cryptocurrency. So obviously that's just referring to different types of cryptocurrency that is available. When we talk about blockchain technology, essentially what are we looking at there? And the blockchain technology is that infrastructure, that how does that actually work? You know, that underlies a lot of these crypto. Essentially, when you think about some of the cryptocurrencies, and we'll talk about Bitcoin and Ethereum, you know, Bitcoin is seen as a store of value, essentially, and Ethereum is seen as infrastructure because of that blockchain technology and what that technology has enabled different innovations and different applications on it. We talk about proof of work mining, and I'll actually talk about this in the context of Bitcoin as well in the latest slide. Cold storage. This is a really important one because we talk about it in our context as an ETF, because the cryptocurrency that we hold within our ETFs is held within cold storage. So what does that actually mean? Well, essentially, it's held away from any online access. So it's the most safest way for us to hold cryptocurrency to ensure that we try to protect it from hacking. So that cybersecurity element of it. So cold storage is something that we obviously look at and as something that we've been focusing on when we've talked about the custody of the cryptocurrency that we hold within our ETF, because obviously this is an asset class. This is an area and investment that you do see in the media every second, third day. People, hacks occurring, and that cybersecurity element is really important as well. So these are some of the key terms that often are referred to within the cryptocurrency world. Just in terms of the size of cryptocurrencies, I do apologize. I wanted to try and showcase, but this is really small, and I do appreciate that. But what you can see here is the top assets by market cap. Now, this is taken from as at the 3rd of July. But what you can see there, if you can sort of zoom in, or I can sort of talk you through it, but the largest asset by market cap is actually gold. So gold has over between 11 to 12 trillion dollars in terms of, and that's US dollars, by the way, in terms of its size. Because of the recent volatility and the price moves with Bitcoin, it's actually come down in terms of its asset size, and it's under $1 trillion. So what are we actually saying there? One, what are we trying to show you? That the crypto market, and just if you take Bitcoin alone, it is relatively small compared to broader asset classes. Even if I try to look at, number 2, Saudi Aramco, number 3 is Apple, number 4 is Microsoft, 5, Google, Amazon, Tesla, Berkshire Hathaway, they're all equity stocks. So the equity market on a global scale is much larger than the crypto asset market. The crypto asset market gets a lot of exposure, and there's a lot of benefit, and there's a lot of innovation still to occur, but it's still very early days. So that's something that we always have to be mindful of. And when you're in early innovation, there is higher risk from an investor standpoint. There may be perceived increased volatility, which again, certain investors will talk about what investors should be looking at from that perspective, but it is very early stages, and it's still relatively small. Gold, for example, is nearly 12 times the size of the crypto asset market. So just keep that in mind when we're thinking about this asset class. It is early stages. It's going to innovate continually. What I wanted to also say is, and a reminder that not all cryptocurrencies are the same. We get a lot of new names, whether it's for tokens, cryptocurrencies, there's a lot of funky logos out there. There's a lot of PR that gets put behind it, a lot of marketing dollars, a lot of brand ambassadors. I've seen a particular cryptocurrency company that's got anywhere from I think it's the largest TikTok or Instagram person, Cabby, I think his name is, from Italy. You've got, Cristiano Ronaldo, you've got David Beckham, you've got, whoever you could name. You've got LeBron James is also an ambassador. So what I would say there is, cryptos can be a store of value. You've got cryptos that can provide bolting rights for different blockchains. But with cryptocurrencies, there's a lot out there. There's something that you need to understand, like we do in the ETF world, which is you want to lift up the lid. You want to look underneath and actually understand what's backing that ETF. In the same way with the cryptocurrencies, you want to go down a bit deeper. And actually, a really good analogy on how to consider cryptocurrencies is, again, looking at the equity market. Equity markets is an asset class, or the equities are an asset class in themselves. Cryptocurrencies are an asset class in themselves. But within equities, you've got different regions, you've got different sectors, different sub-industry groups. Comparing, say, a Apple to a BHP, well, what's driving Apple and its share price and its operations is very different as to what's driving potentially BHP or even CBA, Commonwealth Bank. Three very different stocks, three very different fundamental drivers in terms of their price, different operations, different sectors. So that's the same way we should look at cryptocurrencies, in the sense that there is going to be big differences between all of them. And when we go a little bit deeper in terms of the actual differences, you can actually see here. So what are we trying to show you here? Well, we're trying to show you that not all cryptocurrencies are the same. So whether we take, for example, the layer zero. So layer zero is essentially the infrastructure, the roads that make traffic possible. So think of it like that, your highways, etc. So that's cryptocurrencies like Polkadot and Cosmos. You then have a layer one. Now, layer one is probably, the building blocks on that ecosystem that essentially facilitate apps to be built on. So Ethereum is a perfect example. So that's your layer one. That's your, the smart contracts, etc. That's your layer one. Ethereum is obviously the most dominant and the biggest, but other ones like Cardano, Solana, etc. You then look at scalability, and that's essentially looking at cryptocurrencies that can help speed up to make transactions faster. That's something that we'll talk about from a Bitcoin element, and an Ethereum side, the transaction speed and why that's important. You then look at big data, and in terms of building that bridge, this is sort of where you start to build this bridge between the virtual world and the real world. So for example, for some smart contracts, you need real world data like trading prices or temperature. And this is facilitated by Chainlink. You then look at financial services, which is probably quite straightforward in terms of what that's looking at, or payments. And that's looking at, lending protocols, decentralized exchanges, cross-border solutions. And then we look at commodities, and this is where Bitcoin comes into it, which is why it's seen as a store of value. And then the last one is probably an area which is seeing much more growth is in things like NFTs, the gaming, the metaverse, sort of Web3 element of it. And that's essentially what we're trying to show you here is not all cryptos are the same. There is different investment theses for looking at different cryptocurrencies. And that's why when I look at, say, Bitcoin versus Ethereum, I'm looking at Bitcoin as being, whilst it's the largest cryptocurrency by market size, it's a store of value. There's elements to this, which is there's a supply, scarcity, potential there in terms of you can't have more than 21 million. With Ethereum, Ethereum is that layer one blockchain. It's essentially looking at, the blockchain technology. It's the second largest cryptocurrency, but it's infrastructure. So think of it in that way. That's why there's a lot of references that gets made between cryptocurrencies and, things like commodities, etc. And we'll try and stay clear of that because I think that can potentially confuse a lot of people. But that's essentially what we're trying to show you here. There are differences between the two cryptocurrencies. So it's very hard to compare the two. And therefore, from an investment perspective, you're investing it for different reasons.
Yeah, and I suppose as an investor, it's both sort of, I guess, understanding what that technology or token might sort of promise and sort of understanding the investment case for it.
Exactly right. And so when we look at Bitcoin, what are we actually looking at here? So it's going beyond just, digital assets. It's looking at an emerging store of value, but it's very hard to compare because of its youth. And we talked about the fact that, cryptocurrencies have only been around since 2008. But its value essentially comes from its scarcity. So when you think about its value, is only based on the fact that by 2140 is the date in which all 21 million Bitcoins will be mined. Currently, you have about 19 million that have been mined and that are in circulation. Now, obviously, of those 19 million, there's a lot that have been lost as well. Whether you take the Scottish investor who's lost his, I think it was this is last year when Bitcoin was hitting its peaks, but at that point I think it was about 250 million US that he had lost on a computer that had been thrown into the dump. So that's obviously gone in terms of its circulation, but it's things like that. If you think about how much have been mined so far, about 19 million. But that's the point that comes into it. It's the scarcity aspect. Now, Bitcoin has been seen or is believed that it could be a inflation hedge, and it may not be that right now, given where inflation is sitting. But as the scarcity increases around Bitcoin, it takes away from that inflationary pressure. So potentially in the long term, in the same way certain assets offer an inflation hedge, there is a belief that Bitcoin could be that as well in the long term. Maybe not so much now, as I've said, but potentially in the long term. When we think about, something like adoption, we've seen very prominent cases of adoption more recently from institutions, corporates, on the educational side as well, university endowment funds, etc. And even now at the moment, investment banks coming out and talking about where their belief is around cryptocurrencies. There's still a lot of pushback from some of the more traditional corporations, but I do feel it is starting to turn. And cryptocurrencies in general, we're starting to see a lot more insight from regulators and also central banks as well, whether it's themselves looking at their own, launching their own digital currency. But the idea of the fact that they're leveraging from what is a new asset class and learning from it is important. Obviously, there are some potential downsides. I've mentioned regulations, and I think this is going to go hand in hand. And I think this is an evolving space because as a new asset class, as a new, obviously when you think about Bitcoin came around from being the first decentralized peer-to-peer open sourced, investment. It's transparent, it's reconcilable. That was its benefit. But that obviously scares a lot of governments. It scares a lot of regulators. So there's some time that needs to be had and work that needs to be done by these regulators, by governments to get comfort. The fact that it took us 5 years to launch, very simple, to be completely honest, from an operational perspective, ETF that just buys physical Bitcoin or physical Ethereum, and we simply track that underlying price. We give the ability for investors to redeem for the underlying crypto. It's as basic as you can get in the way in which we've structured our gold fund, as basic as that. It's backed by physical gold. These two ETFs that we've launched are backed by Bitcoin, physical Bitcoin and physical Ethereum. It still took 5 years for all the different service providers, all the different stakeholders, all the different regulators to really become comfortable with what we're doing there. So again, there is a long road ahead of us, but regulation obviously is a potential downside. Environmental concerns as well, and we'll talk about that. The fact that it is quite an energy intensive process in terms of that Bitcoin mining element. And that's something that, when we talk about, we look at here, which is the areas that need to be worked on. So not going to shy away from that, but it's more a case of with more discussion, with more innovation, the fact that we can try and, streamline the ability for an investor to access Bitcoin and Ethereum for more, investors that don't want to go down the path and open up a cryptocurrency wallet or an account. That's fine. There may be reasons why you may feel that you should, but we just wanted to offer an alternative way for people to invest in these asset classes. And when we're looking at the environmental impact, obviously that's looking at the mining process, which you can see on this slide here. It is the proof of work, so it's very energy intensive, but essentially this is how you validate things in a decentralized fashion. So it is one of those things that, to validate, say, if you were to transfer money across from a different bank, that process still needs to occur. There needs to be some validation there. In a decentralized fashion, this is a process that is used. Now, I know a lot of Bitcoin miners, I know a lot of validators are also looking at how they can become more energy efficient using clean technology. So they're looking at, relocating to countries like Norway, which have more efforts and focus on clean technology solutions, whether it's hydropower, hydrogen, battery, etc. There is obviously this big trend that is occurring, and that will continue to occur. But that is something that needs to be looked at. But on the slide here, obviously, we're looking at this process. So what are we trying to show you? So how does Bitcoin work? Well, if you had person A wanted to send 1 Bitcoin to person B, well, that single transaction that's occurring, it gets combined with other transactions, and all those transactions together form a single block. Now, this single block is then sent to other miners and validators, which essentially is that decentralized network, and they all need to agree that this is a valid transaction and this is a concept called proof of work. So that's essentially what that process is. So the block needs to go to a collection of validators and miners, and they need to agree that that is a valid transaction. Now, this process involves essentially solving mathematical puzzles. And once this occurs, the block is validated, and essentially then it's allowed to be added to that blockchain, which essentially means that it's visible to everyone. So this is the peer-to-peer aspect. So as I mentioned, in the same way you send money via a bank, whether it's from ANZ to a CBA account, that process still needs to occur, but we're doing that in a decentralized fashion. So those transactions need to be validated and verified, and being open source and peer-to-peer, that's the process that occurs. Now with Bitcoin, this was the first type of blockchain technology. So this whole process that we're talking about here takes about 10 minutes. And this is, I guess, a potential issue in the sense of it's not as efficient as it could be. To put it in perspective, look at Ethereum. So this process within the Ethereum blockchain takes about 14 seconds. So 10 minutes versus 14 seconds. That's where there's been a lot of discussion around how there can be further innovation, and that's where you will see further innovation. And that's where technologies such as Ethereum have come about.
And that's also where you look at other sort of tokens and some of the promise of other cryptos as well, right? Is the sort of promise that, well, they can do it at scale, faster, more efficient, more transactions.
Exactly right. And that's 100% correct. So that's just something that, when you're thinking about different types of cryptocurrencies, as we talked about, not all of them are the same, and then there's reasons for that there.
Yeah.
I've touched on this obviously, but the idea of cryptocurrencies, it's being used on a much wider scale now, especially Bitcoin in particular. Then that's what we're looking at here. Whether it's the university endowments of Harvard and Yale, whether it's financial institutions, we've seen some of the local banks here already look at talking about offering cryptocurrency exposures. We've seen a lot of more mass adoption, and even at the government level, countries like in South America looking at adopting Bitcoin as a form of payment. And then you look at companies as well, Tesla, Square. I was reading the other day, I think, Gucci, for example, is offering or opening up to allow Bitcoin payments for their goods. Even in Dubai, one of the largest retailers in terms of shopping centers is now offering the ability to buy, goods within those department stores or shopping centers via Bitcoin. So again, crypto is being used much more in real life, and it's only going to continue to do so as well.
And as you sort of mentioned, regulation is a bit of a challenge, but do you think that as, these things are increasingly regulated, that will also aid the sort of mainstream adoption of them?
I think it will, because I think as you start to get more comfort from governments at the regulator side, you will start to see probably a lessening of the hurdles that investors or consumers may face to utilizing cryptocurrencies. Again, you may also see central banks. I know the Bank of England is looking at their own type of digital currency. So you may see that side of things. It's utilizing the technology to launch other digital currencies as well. It may not just be Bitcoin itself, but I think by and part the whole asset class will start to receive greater adoption across the board, whether it's at the government, the corporate, and then the consumer level as well. This slide, it just goes back to the idea of the potential demand. It's a little bit of an interesting one. And I think Jack and I were talking about this slide the other day in terms of there are 21 million Bitcoins that will be mined by 2140. So that's just supply. What is the demand though? And now, if this was a normal reserve currency or fiat currency like the US dollar or the Australian dollar, you would say that there is a big market for that currency's use, but it's not unlimited in terms of not every single citizen of the world will be able to use that currency or have a need for it. I think the concept of this slide is to not say that there will be 7.8 billion people using Bitcoin. I'm not trying to say that at all. What I'm trying to show you here is the addressable market is potentially a lot larger than what we may have for traditional currencies. And that's something to be considerate of. Even when we look at asset classes such as equities and Australian equities, the addressable market for an Australian equity exposure is not the entire world from that side. So from what we're looking at here is that cryptocurrency is being decentralized, offering that link away from traditional governments and traditional regulation. From that side, potentially the adoption could be a lot larger. Now focusing a bit more on Ethereum. So if Bitcoin was the store of value and Ethereum is the infrastructure, you can just see here what it's actually showing you. And these are the different protocols, apps, etc., that are actually built on the Ethereum protocol. So this is a perfect example of how Ethereum is that layer one type of technology. You know, it is the infrastructure, that blockchain technology. So whether it's different exchanges, whether it's asset management tools, whether it's infrastructure and dev tooling, or whether it's services, to even the stable coins, Ethereum is the basis for all of that. And that is where we've seen, you know, its interest, its popularity as an investment as well. So I guess why is it important from all of this? You know, you think about if it's the base of decentralized finance and now also the NFT space as well. You know, NFTs are not just memes or funny pictures, but you may end up seeing, you know, corporates and consumers starting to move into that space. You know, things like house deeds. Does a house deed potentially, could that be an NFT? You know, these are things that we can start to, as we move forward in the future, you may start to see more adoption of things like NFTs, and that obviously utilizes the Ethereum blockchain technology. So it's a very big ecosystem. You know, as of, I believe this data is as of the end of March, so this may have changed obviously, but there were over 3,000 projects that were using the Ethereum technology or based on the Ethereum protocol. And when you look at TVL, and TVL stands for total value locked, this shows you that there was over 165 billion that is essentially locked into those types of projects. So that's money that's spent or invested in the ecosystem. Now, in terms of updates, obviously a big part there is obviously the fact that Ethereum is moving from a proof of work to a proof of stake. And that is happening in August. So that's building in, you know, the idea that they're trying to take into account being more sustainable and more environmentally friendly. But there is some downsides. And with anything, there is always going to be downside. And one of the downsides of that is actually because of Ethereum's own success, and that's the very high transaction fees. So whilst the validation process of 14 seconds, and that's really great, if you have more transactions, well, the fees keep on increasing. And this is where you've seen other blockchains, or what they've sometimes referred to as Ethereum killers, they've started to build. And obviously this started to occur a little bit in 2020. Now, from that side, you saw increased popularity in some of those cryptocurrencies like Solana and Cardano, which are other layer one cryptos that were getting traction because of that. So it's essentially something that needs to be considered. It's obviously going to come down to the fact that there's going to be constant innovation around this type of blockchain technology, and especially around that cryptocurrency space as well. But that is a potential downside that we may see. When we're looking at, you know, I've talked about this already, but, you know, when we're thinking about Ethereum, the widest usage of it, and, you know, it's not just, you know, you look at just that ecosystem that I showed earlier and think about NFTs. Again, it's not just a picture of, you know, a monkey or, you know, some funny meme, as I said. It could be more than that, whether it's even stamps, whether it's even house deeds. This is where we may end up heading. But obviously everything starts in a fun space. And then as you start to develop that technology and innovate it, it can move on into being a much more practical solution in the future for how we live our day-to-day lives.
And I guess that's a big part of the conversation when we look at something like Ethereum, right? That it's, you know, the more useful or valuable the projects that are built with Ethereum, the potentially the more valuable Ethereum would become.
And a big part of that is actually smart contracts. So if you think about how currently, you know, in Australia, when we buy or sell a house, the process and the paperwork that just goes into that, or when you start an employment and you have contracts that are there, or when you have contracts with service providers or suppliers, if you're you know, in a small business, whatever it may be, there is a really big potential for contracts to move to that sort of blockchain technology to become, you know, easily accessible, transparent, that can be validated in a much more streamlined way, and we can become more efficient as well. So there's areas and industries like the legal industry that could see mass disruption because of blockchain technology. We're already seeing, you know, corporations exchanges. The ASX is looking at utilizing, the blockchain technology in terms of settlements, for example. So there's just elements there that we will continue to see. And if it's being built on, as you said, if more and more gets built on that Ethereum technology, that's where the investment thesis or the value of Ethereum starts to grow. When we looked at proof of work versus proof of stake, this is important to just understand what's actually occurring here. So just to simplify it, essentially, proof of work is when a miner solves the maths problem and the miner receives a premium, and that's essentially a token of the blockchain. It's a very simple approach to think of it. The proof of stake is essentially that the validator is selected by how much money or deposited capital they have in that particular blockchain. So that's essentially the way to look at it. They do still receive a premium, so the validator will receive part of the transaction fee, but it is aimed to be more energy efficient because when you think about the proof of stake systems, there's more cost and energy efficient compared to that proof of work. So this transfer from an Ethereum side is actually occurring in August of this year. So again, it's a big step forward when you think about the energy problems that cryptocurrencies have had in the past, and the fact that this is actually occurring is a really big positive step forward for Ethereum at the moment. When talking about the market outlook, there's nothing to shy away from that. When we look at the crypto, well, to be fair, if you look at a lot of markets, the sea of red for 2022, I think when one of the shining lights, from an ETF security standpoint, is our gold ETF, because it sort of stood through a lot of that sea of red. But when we look at crypto asset markets at the moment, and this is as at the end of June, the market capitalization of crypto assets is roughly around 895 billion US, and that's down about 35%, from 1.4 trillion, which was recorded at the end of May. So a really big drop down, especially in the month of June. So Bitcoin's valuation, it went down nearly 40% in June. It's the second worst month that it's ever had. Ethereum was down 48%. You did see some big winners, things like Cardano, obviously, didn't have as much of an impact in the month of June. But why has that occurred? So obviously, there's that intensification that we've seen from the Ukraine, the Russian conflict. There's general sentiment around markets and the fact that interest rates are rising. Is that actually, pulling back on inflation as central banks, have this struggle of what's occurring? This belief that we've sort of got a recession coming and it's starting to become reality. So that's obviously affecting equity markets as well. You've seen that the S&P 500, the Euro Stock 600, so that's the European equity benchmark, they recorded the worst first half since 1970 and 2008, respectively. So 1970 for the S&P 500 and the Euro Stock 600 in 2008. So, there's been a sort of contagious effect that's occurring, across from equity markets over then into other different asset classes, and cryptocurrency is not immune to that as well, as investors try to pull away from investments and maybe cash out and sit on the sidelines to try and pick out opportunities. And then the other side of things within cryptocurrency industry as well. You saw from the aftermath of that sort of stablecoin collapse in May. You also saw bigger cryptocurrencies and companies potentially having and facing some issues, and even on the regulatory side as well. So one thing to consider, I guess, is crypto and an industry, it's on a build mode. We talked about the fact that the cryptocurrency market, it's still very, very young. It's only been around since 2008, really. And the build mode that generally the crypto industry goes through, it's always been during its bear markets in the past, and we're only going to see that again. So one thing to consider, though, is what makes this different to, say, what occurred in 2011 when you saw a drop of, again, 40%, or when you saw a monthly drop of, and by the way, this is a Bitcoin US dollar performance, or a drop of 37% in 2018. Nearly similar drop in sort of 2020. That was obviously COVID related, but we've seen that drop more recently. One of the big differences there is institutional recognition and backing. And, we're seeing actually a lot more. The fact that, again, we're sitting here talking about a Bitcoin and Ethereum ETF, it's a vastly different proposition to what it was in 2011 and in 2018. So that's just something to keep in mind. The asset class is evolving, the asset class is maturing, and so it is a different context to what it has occurred in the past. Now, we've also seen opportunities that investors are taking, and one, for example, is Michael Saylor, very well-known investor, for example, recently bought $10 million worth of Bitcoin over the past month. So that's in the month of June, and this is actually a really interesting chart because what I'm looking at here is the number of addresses, and that's in the yellow, with a balance of more than one Bitcoin. And you can see here that as the price is going down, this is only for the past 3 months, that as the price has gone down, people are actually taking advantage of that. So this is something just that we're seeing a lot more investors at an individual level buying the dip over the past month. So you've got this institutional recognition that's occurring, but then you've also got this aspect of it, which is people actually buying, individuals, consumers buying the dip. Now, one of the ways in which they can do that is obviously going and physically buying cryptocurrencies. But I guess the other way, from our side was obviously looking at the ETF standpoint and what we're seeing there. And obviously we launched these ETFs in May of this year. Some may have said, why did you launch? Literally, I think we launched it the day of the stablecoin collapse. Just time, it's not about timing the market, it's about time in the market is what we say. So, and I think for us, it was wanting to be first in the market for a spot Bitcoin and a spot Ethereum. And so these were the two ETFs that we launched. And the first one being the Bitcoin ETF, the EBTC. It's backed by 100% of actual Bitcoin, held in cold storage by Coinbase. And we'll talk a little bit around the structure as well. And then the other one, obviously, is the Ethereum ETF. Again, similar price, exactly same structure. We hold 100% fully backed by actual Ethereum, held in cold storage. And actually, for both of these, they can be redeemed for the actual cryptocurrencies if you wish, in the same way our gold fund can be redeemed for the actual gold as well. Now, in terms of how Bitcoin or Ethereum ETFs work, it's important to understand because we've had quite a lot of questions since we've launched these. We're not buying miners, we're not buying equities within these. We're buying actual Bitcoin and actual Ethereum. So essentially, the basic sort of structure of it works is that when you buy one of these ETFs on exchange, that ETF is purchasing underlying that Bitcoin or Ethereum. What does this actually mean though for you as an investor? Well, you have actually an entitlement, and you own essentially a part of Bitcoin and a part of Ethereum through this ETF. There's a direct entitlement in the way in which we've structured this. So that is really important. Now, where does that underlying cryptocurrency come from? In the ETF ecosystem, the way in which this operates is we work with service providers and stakeholders called market makers and authorized participants. And they will, when we're creating more units of the ETF, and so we need to back it with actual Bitcoin or actual Ethereum, they will go out and actually buy these cryptocurrencies to ensure that this cryptocurrency is backed by that currency. So when you think about it, for every dollar in the Bitcoin ETF, it's backed by $1 of Bitcoin. So every dollar of the Ethereum ETF, it's backed by $1 of Ethereum. That's the easiest way to approach it.
And just on that, we have a question from Michael as well, which I think I might just throw in here because I think it's applicable. But he asked, what's the benefit in owning a crypto ETF rather than, for example, buying Bitcoin or Ethereum directly?
Yeah, so I think there's two questions there, or two answers, sorry. One is you don't have to have a crypto wallet. So you don't, that aspect of not needing to store your own private key, the security behind it. When we're buying, the crypto within this and the cryptos that are held underlying these ETFs, it's held with institutional grade custody. So it's insured as well against hacking and any other potential issues that may occur from that space. So that is something there that, from our side, we actually see as a real big benefit. The other aspect is how that person is holding these assets. Now, it may be easier for them to buy something like this ETF versus going out and opening up a wallet and buying it through another exchange. So, if you're already on the Superhero platform, you may just find it easier to have all of that information stored within that Superhero portal, and easiest to do that by the ETF. The other thing is to think about from a super perspective. If you wanted to hold Bitcoin or Ethereum within your super, now again, these are highly risky investments. They're very volatile. We've seen that the fact that it's down nearly 30 or 40% just in the month of June. So please keep that in mind in terms of when you're looking to buy into these types of assets. It's for that particular type of investor. But from that perspective, what we actually see here is you may have an ability to buy these within certain structures and trusts and SMSFs, for example. So again, it's opening up the world of buying cryptocurrencies. And if I take it back to actually when the founder of 21 Shares, it's a person, there's two co-founders, Hani and Ophelia, and Hani Rami and Ophelia Snyder. Now, they're both, quite young entrepreneurs. They've started 21 Shares, so they've launched this business from essentially zero and got it to about $2.5 billion in assets in cryptocurrencies. And the reason why they launched was because their mums were talking to both of them individually and saying, we want to invest in Bitcoin, but we don't know how. And that's basically where it comes to, is these ETFs are not for everyone. If you've already opened up a wallet, you're comfortable along that line, you're comfortable with using some of those crypto exchanges, that's absolutely fine. From our side, obviously, we're just wanting to make another vehicle in which you can access different asset classes. So the fact that for us, we were the world's first provider, we launched the world's first physical gold ETF. And the only reason for that is, in theory, you could go to a gold miner or a gold dealer and buy physical gold. That process occurred and investors could do that, but it wasn't for everyone. So in the same way with this, it's just opening up a different way to access different asset classes, and that's all we're trying to achieve there.
That's right. And and that sort of, I think, is a great point to make, because there are a couple of comments in the Q&A sort of saying, it is a volatile asset. It's risky, speculative. What reason would convince me to sort of invest in it? And I think that's a great point, that, you don't need to be convinced to invest in it. It may not be for you. If volatility does worry you, then cryptocurrencies may not be the right fit, and it is something you really do have to assess for yourself.
100%, and it all comes back to diversification. So I've seen a question come through from Adele, I believe it is. Normally ETFs are diversified. I think probably just a bit of a lesson there in terms of an ETF is a vehicle. It's a vehicle, and generally it's passive. So what do I mean by that is, an ETF tracks an underlying benchmark. Now that benchmark can be a basket of stocks, which is equity ETFs, so things like our ACDC ETF or our Robo ETF or our FANG ETF. They invest in a basket of equities, a basket of stocks. So yes, they're diversified because they're providing exposure across a number of different names. But the benchmark can also be a commodity. So we have a physical gold ETF. It invests purely in physical gold. But when you're utilizing that particular ETF alongside other investments, that's how you become diversified. That is a really important thing to consider, is we're not saying buy just one ETF, buy just Bitcoin or buy just gold or buy just ACDC. No, your portfolio should be diversified across different asset classes. And even within those asset classes, when I think about equities, it should be diversified across different regions, whether it's Australian equities, international equities. And then even within international equities or Australian equities, it should be diversified across different sectors as well. Now, yes, you have ETFs that can offer you a bit of a one-stop shop. What I'm talking about here today in terms of cryptocurrency ETFs, it is purely a way to access one single investment. So used alongside other investments, that is really important. It is not to say that this is just the only way that you should look at building a portfolio by buying a Bitcoin or Ethereum ETF. 100% not. Please do not. That is something that should not be done, because they are very volatile and highly risky assets. The way in which I see Bitcoin or Ethereum or cryptocurrencies is a growth alternative. So within your portfolio, you generally have equities, fixed income, and you have alternatives as a basket. And gold for me is a defensive alternative. It's a safe haven asset. It's an insurance, a portfolio insurance. It protects, has an equity hedge element to it, an inflation hedge element to it. And cryptocurrency or Bitcoin, for example, is a growth alternative. Highly risky, but potentially used alongside many others investments could have a beneficial impact on your portfolio. But again, the diversification is a key term there.
Absolutely. There are a few questions in the Q&A, but I'm conscious I may have hijacked the end of your presentation. So I'll give you an opportunity if there are a couple of other slides before we jump into the rest of it.
Yeah, sure. So just something to note there, and this comes back to the fact that what are these ETFs actually investing in? And they are obviously investing in underlying Bitcoin and underlying Ethereum. So when people look at the price of these ETFs online, that essentially is what they're looking at. It's for us, we're providing a vehicle to create a very efficient, easy way for an investor to access the underlying cryptocurrencies. So when we're looking at this, we're looking at what is actually the net asset value of the fund. Well, it's essentially calculated by the entitlement of the coin for each unit to the price of Bitcoin and Ethereum. And so that's essentially what you're looking at. In the same way we look at our gold ETF, it's a one-for-one in theory. The only tracking error that we perceive we will have, so the tracking error essentially is referred to as the difference between what the actual ETF is and what we're trying to track, the benchmark that we're trying to track, should in theory be the fee. Now, that's our job as a provider, as an ETF manager, to try and minimize that tracking error. And with something like this, that's how we believe we can solve and provide that solution for investors. And that's how we see it. It's not for me to say Bitcoin and Ethereum are right for anyone. What we want to do is obviously provide a solution, and that's where, as an ETF provider, that's what we're looking to do. I guess the key part there, just in terms of the ETFs versus direct, and this is something that we've talked about very quickly before, but it's that institutional grade custody. So all the cryptocurrency that we hold within our ETFs, it's held within cold storage. The sharding of keys. So you talk about those private keys that you as an individual may have. Well, the keys that we have for our cryptocurrency, it's actually sharded. So it's split up into many different keys that, ensuring the security of it. It's held, the cold storage aspect of it, it's held essentially on a USB, but it's within a Faraday cage, again, to protect against hacking. And the last part is, worst case for what would happen if something were to occur, is it insured? And yes, I can tell you that, the cryptocurrencies held within our ETFs are actually insured as well. But that sort of finishes it for me in terms of the slides. Obviously, we've got some information here and some details there in terms of if anyone wanted to talk to ETF securities, whether it's via our website, the client services, or if it's a trading query specific to this ETF or others, that's the number to call. But Jack, I guess over to you for any of these other questions that may be coming through.
Yeah, that was perfect. Well, there is another question which I'll jump right into, but just because we did kind of finish with a bit more information around the ETFs there, and one of our attendees has asked, can the ETF issue new units? So can new units be issued in the ETF and hence dilute the existing unit holders of their percentage entitlement of the underlying Bitcoin or Ethereum?
So an important part there is when you're talking about an ETF is an open-ended investment vehicle. So what do I mean by that? What I mean there is every time new units are created, we essentially buy the underlying exposure. So there should not be that dilution element that you're referring to there. So it's very different to a listed investment company or a traditional share, where there's a finite amount of units that are on issue. For us, it's open-ended, so we can create more units, and by doing that, we have to buy. So every time we create another unit of this ETF, it is backed by, a dollar created will be backed by $1 of cryptocurrency. It's the best way to think of it. There shouldn't be a mismatch between the dollar amount of the units that are created and the dollar amount of the underlying exposure held. It should be one-to-one from that perspective. And that's how we've operated with all of our ETFs. I look at our gold ETF, we hold over about 2.7 billion in physical gold. And that's essentially all held attached as an entitlement to the investor.
Yeah, and there's two more questions here, which I can guess the answer to, but I'll let you answer them. Would I be able to use these ETFs as cryptocurrency for purchases? And do the ETFs provide distributions or dividends?
Yeah, so in terms of being able to use these ETFs as cryptocurrencies, for purchases, no is the answer, because the ETF is the investment vehicle. The investment vehicle holds an underlying cryptocurrency. As I've said, you can, but there are costs associated with it, and there is a process involved, but you can redeem your units for actual cryptocurrencies if you wanted to. In the same way with our metal products, you can redeem for actual metal, at which point you essentially have ownership of said cryptocurrency or said metal. And at that point, yes, you could use it for however way you wished. And do these ETFs provide distributions? There is a facility for us to provide distributions, but no, given the fact that unless there's any type of forking that occurs that ends up creating any sort of gain within the ETF, at that point there will be distribution that will be provided. But outside of that, no, these ETFs are not intended to provide distribution.
With these ETFs, I assume the sort of the idea, to sort of put it in other words, is you're investing on the basis that you believe that the value of the underlying asset, e.g. Bitcoin or Ethereum, will increase, and therefore the value of your ETF would increase.
Exactly. I think if you're looking to utilize cryptocurrency in a more transactional form, then potentially ETF as a structure is not for you. Because they're not seen as being a transactional form in terms of I can take that and I can use it to buy goods and services, etc. That with corporations that allow Bitcoin payments. No, I would say that that's not how these ETFs should be used. These ETFs should be used from an investment vehicle perspective.
Exactly. And this is another question which I think I'll actually answer, just because it goes to superhero. We didn't plant it. The question was, how does your ETF offering work with your partnership with SwiftX on both platforms, and wondering about what your partnership offers. So for those who don't know, Superhero recently merged with a crypto exchange called SwiftX. Basically, unlike ETF providers, with SwiftX, for example, you could purchase cryptocurrency directly. The idea is that over time we'll be able to merge those two offerings, so share trading and crypto trading. You will merge them onto one platform, so you'll have the option to invest in both asset classes on a single platform. You're obviously, if you only want to trade equities, you can just trade equities. If you only want to trade crypto, you can only trade exclusively crypto. But it's just to give users and investors options, I suppose. So that would be an alternative to investing directly in ETFs. But obviously, you've got to consider, what's right for you and what works for you as an investor. I'm just looking through the questions now. I think we've got through quite a few of them. One person, this isn't a question, I'll take it as a comment, but they said, I got hacked on July 1 from my ledger for 0.4 Bitcoin and 3.5 Ethereum. My own fault. I'm bleeding, but I'll heal. And I guess that is sort of one of the sort of risks you pointed out to do with cryptocurrencies, but something that the ETF structure I guess tries to mitigate against with cold storage and sort of taking care of the security of the asset itself.
Yeah, and I think for us it's about removing that hassle and making it easier. So it's just trying to make this easier for investors to access what potentially has been in the past a more difficult asset class to access, in the same way we look at gold, or in the same way we look at any of our ETFs. To be honest, we want to provide a solution for investors, and that's all we're aiming to achieve. The easiest way to do that. I do see questions around the fee structure. Just something to note there is, if we talked about the fees, it's 1.25% per annum for Bitcoin for both ETFs. It's 1.25% per annum is the management fee. That is the only fee that we charge. But that's if you held the ETF for 12 months. So if you held it for 6 months, for example, it would be half of that, is the best way to think about it. So the fee, obviously, and people have asked this question, why is it considerably higher compared to other ETFs that are in the market? And again, context needs to be provided here. This is a new asset class. The costs of managing the underlying are a lot more expensive, especially on the custody side. So that's the holding of the cryptocurrency versus how we hold, the equities. Very developed market, very cost efficient structures in place. With cryptocurrencies, it's not there yet. as things develop and as, continued technology is used and innovation and advancements are made and more cost efficiencies can be gained, we will 100% look at lowering those fees. But part of that reason of why it's so high is because of that that underlying, the management, the custody side for these funds.
Yeah, well, it is, I believe, 1:30. So we might wrap it up there. I know you've probably, thank you so much for joining us on your lunch break, everyone. It's been a really insightful chat, and thanks so much to you, Kanish, for running through, what is a really interesting asset class, something investors may want to consider adding to their portfolio, but it's been a really, I think, in-depth, fascinating chat. So thanks so much for joining us today.
No, thank you for having me, Jeff.
Perfect. Any questions that go to Superhero, we will try and answer them via email. And yeah, enjoy the rest of your Tuesday afternoon, and please do join us for our next webinar. Thank you.